All right, so I'd like to welcome everyone to the webinar that I'm hosting today on the current state of the New York City office space market. Now, there's obviously been a lot of speculation as to what's been going on, especially given COVID. And so what I'd like to do today is go through a few different things that I'm experiencing in the market to give my perspective on what I feel is going on and what we can expect moving forward in the near future. So to give you a little bit of a sense of what we're going to cover, we're going to start with some comparative data points so that we can see what the numbers look like from a certain period of time ago until today to give us some sort of frame of reference as to what was versus what is in order so that we can see what will be in terms of what's coming next. We'll also be discussing what the market will look like for the next 12 to 18 months. A lot of those of you who are on here right now are business owners or CEOs, and you're curious as to what the market's going to look like because that might inform a decision that you're going to be making from a real estate standpoint in the near or the short or near term. The next thing I'm going to touch on are the strategies that are being implemented by the various CEOs and business owners that I've been in touch with and that I consult with in order to help provide some perspective as to what some other people are doing, which might help inform your decisions. The last thing that we're going to cover is a kind of a Q&A session. And here is where it's important that if you have a specific question on something that I haven't covered, I really encourage you to type it into the chat box on the bottom of your screen. This way I can address any questions that you might have at the end of the session. So let's get going. So we're going to look at some data points which might give you some sense as to where the market was versus where it is today. First, we're going to start with the availability rate. Now, what's the availability rate? The availability rate is a metric that measures the amount of space available over the next 12 months. And so what we can see is what the space is going to be that are coming online, which will help give context on what's available. So in the third quarter of 2019, the availability rate was 12.6%. Now, it's important to consider that you're talking about a market of 500 million square feet when you're talking about office space in New York, approximately. And so when you're looking at 12.66%, that's obviously a big number. But when you look at the availability rate at Q3 2020 year to date, you're looking at an 18.2% availability rate, almost 50% more than it was 1 year ago at this time. That's obviously a drastic increase. The next point that we're going to look at is the available square footage. Now, again, this ties into the availability rate, and it ties into how many square feet are available in order for tenants to be in the market, right? What they can look at, what they can take, and what they can expect. In Q3 of 2019, you looked at 36 million square feet, whereas if you're looking year to date for Q3 of 2020, you're looking at 54 million square feet. That's 18 million more than last year. Now, that's a massive number, especially given how activity has gone in the last 6 months. That's something we're going to look at next, but just look at that number. That's a huge difference. So the last data point that we're really going to touch on today is leasing activity. What has leasing activity looked like last year versus this year up until this point? And the numbers are staggering. You'll notice that in Q3 of 2019, about 7 million square feet were transacted, versus today, Q3 year 2020 year to date, you're looking at about 1.9 million square feet. Now, that's nearly a 70% reduction in activity, which is very significant. Now, listen, will things change in the coming months? Absolutely. Have we been on pause? And will things start to ramp up once we get a little bit further on with a few things that are going on in our world? Absolutely. And those are some things that I'll cover a little bit later on in the presentation as to what those factors are that should be considered and what we're going to be seeing. So now we're going to touch on what the market will look like in the next 12 to 18 months. And overall, the best way to summarize it is that we have entered a tenant's market. Up until this point, there's been a tremendous amount of a landlord's market. Basically, since the last recession in 2008, 2009, it's been very much a landlord's market where landlords had essentially all the leverage in any negotiation, right? And so what we're going to talk about to begin with is that the market was already overheating before COVID. Now, we all know that business happens in cycles. And to say that COVID is the cause of this down cycle is not the correct perspective, in my opinion. If you look at the numbers in the 12 months prior to COVID, rent growth had been flat and concession packages had creeped up to crazy points. I finished a deal last year. It was a renewal for a client on Fifth Avenue, a full floor. I negotiated a deal in which that tenant got 12 months of free rent on a 10-year deal. Now that's obviously hugely significant. In addition to that 1 year of free rent, I also negotiated the same amount of value in tenant improvement allowance, where the tenant would be able to modify their space and make changes so that it makes it feel like a new modern space. The caveat there is that I also negotiated that they would be able to convert that TI package to free rent in the event that they did not want to use all that money. So what that is to say is that you're looking at a concession package that's nearly 20% of the value of the lease. So the market was already overheating before COVID. We were at the top of the cycle, and COVID kind of came and gave it a nice swift kick in the pants to get things moving. But the reality is that we were overheating before COVID, and the market was set for a correction. The next thing that I want to talk about as it relates to us entering a tenant's market is the fact that there's a glut of sublease space that has come onto the market. In the last 5 months alone, there have been almost 7 million square feet of sublease space that have come on the market. Almost 200,000 square feet came on the market for sublease in the last 24 hours. Now, that space will begin to put a downward pressure on rents. Why is that? Generally speaking, subleases trade at about a 20% discount to direct spaces with landlords. Why is that? Inherently, within a sublease, you are taking on an amount of risk, given that your sublease is only as good as your sublandlord, or is only as good as the credit of your sublandlord. So should your sublandlord default on their lease, essentially your sublease is worthless. So what's going to happen is that if that tenant goes bust, if your sublandlord goes bust, you're kind of up the creek without a paddle, and it could be very, very dangerous, right? So that's why the 20% discount is factored in. Now, what happens if that sublandlord does go bust? Chances are the landlord, the overlandlord, is not going to kick you out of the space. Why? Because they can kick you in the space even if you're paying significantly less than what the market is or than what the sublandlord was paying. What you can do is the landlord can say, hey, I'd rather keep you in the space, avoid any downtime for my space being leased, avoid any commissions being paid to an outside broker, avoid any free rent packages that I have to give to induce a new tenant to come into the space, and I don't have to put that much money in from a tenant improvement perspective. So this is a big win for a landlord. However, that does mean that they're going to be taking and agreeing to a discounted rent. So that means that automatically the landlord will be devaluing his or her asset in showing the market that they're willing to accept a lower rent. So that in and of itself can put downward pressure on rents. Now, are there ways to hedge yourself against this risk on a sublease? Absolutely. You can use something that's called a reverse security deposit, in which the sublandlord puts the amount of money that is the delta between what the subtenant is paying and what the sublandlord is paying. You can put that in escrow. And what that essentially does is it helps that in the event that the sublandlord defaults, the subtenant can continue paying the same rent that they had been paying at a discount and continue on occupying the space. So that's something that's very, very important to look at in terms of the downward pressure on rents. And so I think we're going to see at least 20% drop in rents. I don't think it's going to happen overnight, but I do think it's going to happen over the next 12 to 18 months. The other things that are very important to consider are the factors that are in flux. One sec, factors that are in flux, bear with me one sec. We're gonna go back. So the factors that are in flux, obviously right now, are number one, a vaccine, number two is the election, and number three are schools. So we'll start from the last and we'll go forward. So when it comes to schools, we know that our current administration in the mayor's office can be dependable in one way. They cannot be depended upon. And whenever Bill de Blasio will say something, you don't know if that's going to be the case or if that's going to shift the next day, the next hour, or the next week. And so until parents have a sense of whether or not their kids can be in school, really employers cannot make plans for their employees to come back if they don't know if they're going to have remote situations for these parents who need to be home, essentially schooling these kids through remote learning, right? And so that's going to be a big factor. Secondly is the election. Now, in any election year, if you look historically at the data, leasing is slower, right? Because people don't know what's coming around the bend. And when CEOs don't have that visibility, it's much more difficult for them to make these decisions. And so during an election year, you're oftentimes going to see a slowdown in leasing activity. And that's certainly what we're seeing here. whether the current administration continues on or whether a new administration comes in, there's a lot that's up in the air. And so you're not going to see very long-term solutions in terms of decisions that people are making right now, by and large. Again, there are exceptions, and we'll touch on that a little bit later. But by and large, without some clarity on the election, there will be a little bit more hesitation by landlords by landlords and CEOs in terms of making longer-term decisions. The last thing that I mentioned, which is obviously, in my opinion, one of the most important things, is the vaccine, right? We don't know when the vaccine will be readily available. We do know that there's an expected vaccine to be approved sometime in the beginning of the year in January, but we also know that that rollout won't happen right away, and it won't be widely available likely until the middle to end of next summer. So if you're looking at summer of 21 as a timeline as to when people might be able to come back in the office, that gives CEOs a lot of wiggle room as to when they need to make the decision, how they need to make a decision, and whether or not they're comfortable to make a decision to bring their employees back until there's a vaccine that's been approved and until people have been vaccinated. So a few more factors that to me that will be affected by the fact that we're moving into a tenants market, and that's how the different ownership structures are in the various buildings. So in New York, you essentially have your REITs, your real estate investment trusts, your large private landlords, and then your smaller private landlords. Now, when it comes to the REITs, it's going to be very difficult for them to drop their prices drastically right away. If you look at SL Green, if you look at SL Green, if you look at Empire State Realty Trust, if you look at Vornado, these stocks have all dropped about 50% since last year at this time. That is a massive, massive number. And if these landlords come out saying, hey, we're doing cut rate prices, we're cutting great deals right now, their stock will drop even more and their investor value will diminish significantly, which they cannot do. They just simply cannot do it. And so what these landlords are doing, what these landlords are doing is that they're increasing concession packages drastically, and they might give you 3 months of free rent in every year of a 10-year deal, but they're not coming down on their asking price. Now, to most tenants, that's okay. But for some tenants, they need to have that dollar number on the face of their lease in order to make their board or their committee happy from a real estate standpoint. So that's on the REIT standpoint. When it comes to large private landlords, you're talking about the Rudins, the Dursts, the Silversteins of Manhattan, right? These are the large private landlords. One could say, oh, well, they can just simply drop their prices. It's not that easy. A lot of these landlords not only have lending obligations, or obligations to their lenders rather, they also have partners in their buildings and silent partners, and they cannot just drop their prices left and right because it will significantly devalue their building right away. So again, in this situation, you're seeing a lot of these landlords buy up their deals by giving significant free rent packages and or TI, tenant improvement packages, and have that convertible as well to help buy up the rent, as they say in the industry. The third ownership structure that we're going to look at are some small private landlords. These are the Czar organizations of the world, the Justin family, the Kaufmans. These people tend to own their buildings outright or have very minority partners and tend to not be over levered. These are the landlords that have already started dropping their prices. The Kaufman organization, as an example, in the last 6 to 8 weeks, when they've listed space, they've listed it at a 15 to 18% discount as to what they were listing it pre-COVID. So that's kind of what I'm seeing from a standpoint of what you're looking at versus at the different types of landlords and the different ownership structures. Now, here are two theories of mine that I think will play a role as things progress over the next 12 to 18 months. Now, obviously, we all know that retail is in a really tough spot right now. So how are these retail vacancies going to affect office space product? Mostly people tend to differentiate the two. However, if you look at a trend over the last 5 or 6 years, there have actually been an enormous amount of landlords who have been converting their second floor space to retail space in order to get more money for that. A lot of these landlords have refinanced their buildings based on very high retail rents and also a doubling of their retail space with that second floor space. So what I believe is going to happen is a lot of these second floor spaces will be converted back to office space in order to reduce the landlord's exposure from a retail standpoint. Now, one might say, how is that possible? We're going to talk about loss factor in the next segment, but what's important to understand is that there's a concept called loss factor in New York City real estate, which means that there's a usable square footage and a rentable square footage. Now, I completely understand how that doesn't make any sense and how it's very confusing. However, what it basically is that a landlord can charge a tenant its proportionate share of use of the common corridors, the bathrooms, the hallways, the elevator shafts, the lobby, all these different types of things. And so they pass on what's called a loss factor. Now, that loss factor can range anywhere from 25 to 50%, right? And so in a retail space, there isn't a loss factor. So even if a retail rent is 20% more expensive than an office rent, but there's a 40% loss factor on the office space, if an office tenant took a retail space, they would still be netting 20%, right? So I think that some landlords and some tenants who might not have considered how retail might be advantageous for them, they might not say, hey, I want only an office space. They might say, hey, I would consider a retail space as office space and see what I can get off the people coming off the street or with some street front exposure. So this touches on my last kind of prediction for the next 12 to 18 months, which I don't know if it will happen that quickly, but we have started seeing it already with a limited number of landlords. So the loss factor trend has gotten, in my opinion, to an untenable point. And even last year, before COVID, I was talking about how it had to reach a point, it had to reach a breaking point. So a loss factor is something that's reasonable and understandable when you're at a reasonable point. But the fact that loss factors have creeped up to over 50% in some spaces, which means that you're paying for more than double the space that you can actually use, it had to come to a head, and I think we've come to a head now. I was speaking to a landlord last week who said, you know what, I'm remeasuring my floors going down. They were 12,000 square feet, we're gonna drop them down to 11,400, right? And so this is a very, very big deal because what the trend was before is that people would buy a building, investors would come, they would buy a building, they would up the loss factor by 12%, flip it 6 months later, and that's their return, right? After that happened a few times, these buildings got to an untenable point. So I think that we might see some landlords reversing their loss factor growth and going to a more usable square footage for tenants to attract them to come back to their buildings. So that's kind of my perspective on what the tenants market is going to look like and why it's going to be a tenants market in the next 12 to 18 months. Now we're going to talk about some strategies that are being implemented by my clients in order to help some CEOs and business owners understand the various angles that people are taking in order to strategize for their business from a real estate standpoint over the next 12 to 18 months. So we're going to touch on a few short-term solutions, and then we're going to touch on a few longer-term solutions. So the example A is a financial services client of mine that had a lease that was coming up right in the beginning of COVID. My advice to him, after asking if he was set up to work remotely and that if he thought he could work well remotely or at least function remotely, he said, yes, I can work remotely. So what my suggestion to him was, allow your lease to expire. Put your furniture, your files, and everything else you need from the office in short-term storage. So you're not paying rent in Manhattan as a storage space. Again, you must ensure that the IT support is in place for efficient remote work. Now, is this client going to be working completely remotely long-term? Absolutely not. This particular client believes that they need to have the people in person for not only collaboration to work on things together, but also from a cultural standpoint. If you're bringing on more people, how are you supposed to ingrain them in the culture of the company that you've probably spent so much time and effort and money building, right? And so this particular client is a short-term solution to allow their existing lease to expire, put their furniture in storage, ensure that their IT support is in place for efficient remote work, and then readdress the market in a little bit. Now, this particular client is deciding that they're going to start re-examining the market in about a month from now, hoping that there is going to be a vaccine around January, and then we can start planning to get back to the office following that. This client also said, though, that they only want to look at full floor opportunities because they want to limit the amount of risk and exposure that their employees might have to other people even within the same building. So that's example A. A second example of a short-term solution is a financial services client of mine that had half of a floor for a 10-year lease. Last year, they picked up the balance of the floor on a lease assignment that ran for about 1 year. Now, that lease assignment is coming due in December, and we had to make a decision as to what we're doing next. Initially, pre-COVID, we had planned to make the second half of the floor coterminous with the first half of the floor so that both leases expired at the same time. Now, what ended up happening when COVID hit is we decided, you know what? Instead of negotiating a long-term extension, we're going to negotiate a short-term lease extension only for a couple of years because we do feel that there will be better value in the market at that point, and we can explore the market then. They did not want to lock themselves in for the other half of the floor beyond a couple of years, because should there be a really great opportunity elsewhere, we can sublease half of the floor that they currently occupy, and then we can move them into a new space and give them a better opportunity to capture long-term value, whether it's a sublease or whether it's a direct deal with a landlord who's willing to bend and move to the numbers that will be beneficial for us and that we feel are market. Now we'll touch on a few long-term solutions. So the first example of the long-term solution that I'm going to talk about is the private equity client of mine. Now, what they've decided is that after looking at all the numbers, after looking at all the people, after looking at all the data from the surveys that they have sent within their company internally, they've realized that there is somewhat of a need for flexibility in terms of their employees. They do like to work from home. Now, they're not going to allow them to work from home completely all the time because, as I mentioned before with another client, they do feel that the efficiency of communication, the collaboration, and also the culture cannot survive properly if people are constantly in and out and not there for the bulk of their time. So they also realize, though, that they don't need to have all the space. So they've been able to decide that they want to reduce their own space by about 20%, right? That's a drastic number when you're looking at rents of $60 to $80 a foot, and let's say a 20,000 square foot space, that's real money. And again, they are doing this by creating a rotational schedule and using a hoteling model for desks and offices where you would share your desk or your office with one or two other people. You'd rotate on certain days, and they're implementing a 4-day work week in the office. Now, that doesn't mean everyone's coming in Monday, Tuesday, Wednesday, Thursday, and not Friday. It's quite the opposite. And so there's different softwares that you can use to implement these kind of situations. And this is the long-term solution that they've put in place, because we're actually committing to a new 10-year deal because they feel comfortable that this is the way that they can work most efficiently moving forward. Now, I think that we're hearing a lot of this type of concept being implemented, a lot of these types of concepts being implemented by much larger companies and much larger CEOs, saying we do need to have some flexibility, but we also need to have a significant office presence in order to really run our business the best way possible. So another example of a long-term solution is a nonprofit client of mine, and the plan here is to sublease their entire space. This company feels that they will be absolutely fine working remotely. Now, they've been doing it already. They happen to be a nonprofit that is focused on remote learning programs. And so I think that they will be able to work completely fine remotely, especially given the fact that over COVID, they've not only done well, not only been okay, but they've actually grown and they've actually done much better. So in this scenario, we're going to be subleasing their entire space. We're implementing a work from home model that's, again, bolstered by proper IT support. I cannot stress that enough. If you don't have the right strategies in place from an IT perspective, your employees are going to stand there with their arms in the air, with their hands in the air, saying, what am I supposed to do? I can't get things done properly. Very, very important. Now, for this particular nonprofit, they do also find that it's important to have a place for their employees to meet a couple times a month in order to collaborate on ideas, have events together. And so what they're going to be doing is using temporary meeting spaces 2 to 5 times per month for team meetings. Now, this is kind of a nice hybrid model, if you don't want to spend your entire budget on real estate, but you also still need to spend some money to make sure that people have the time to get together, build that culture. If you're bringing on certain employees, it's a great way to have a team together to do that kind of stuff. So the third example of the long-term solution is actually, I would say, more the exception than the rule in this current climate. Now, they're actually increasing their space by 50%. Right? And so this to me goes to show that even during a pandemic, there are certain industries that are going to do better, certain industries that are going to do worse, but there is still opportunity out there for people to grow their businesses. They're going to increase their space by 50% for 2 reasons. Number one is that they serve an industry that is expected to grow as a result of COVID. And so they are really ramping up. That's in the long term. In the short term, they're taking the additional space because they want to have their people in the office, but they also want to make sure that their attorneys feel comfortable from a social distancing standpoint. And so if you don't do that and allow them to feel comfortable from a social distancing standpoint, it's going to be hard to get them in. So from a long-term solution, they expect to grow, but in the short term, they expect to utilize this additional space to add a little buffer. Now, for this particular law firm, the managing partner sees a tremendous need for in-person interaction. They have serious mentoring programs, and they have a lot of collaboration between the younger and the less experienced attorneys and the really experienced people who have been in the industry for a very long time. So these are some of the solutions that I'm seeing from some of my clients. I hope this has been helpful in terms of providing some perspective as to what I think we're looking at the current state of the New York City office space market and what we're going to be looking at in the next 12 to 18 months.